If the dollar collapsed tomorrow, the headlines would not be the most frightening part, it would be the silence between transactions, the hesitation before a price is quoted, the uncertainty behind every contract. Because when a reserve currency fails suddenly, what collapses first is not wealth, it is trust. The US dollar is not just money. It is the reference point for global trade, debt, commodities, and reserves. Oil contracts, sovereign bonds, corporate loans, cross-border settlements, all orbit around it. Remove that anchor abruptly, and the system does not smoothly recalibrate, it jolts. History has seen versions of this before. Not with the dollar, but with dominant monetary systems that appeared immovable until confidence fractured. The pattern is consistent. First comes disbelief, markets assume volatility is temporary. Officials promise stabilization. Liquidity is injected. Emergency measures are announced, then comes repricing. If the dollar were to collapse in value overnight, import costs would surge immediately. Energy, electronics, pharmaceuticals, industrial components, anything priced globally would become more expensive domestically. Inflation would not rise gradually, it would spike. Savings held in dollar-denominated assets would lose purchasing power rapidly. Fixed incomes would feel compressed. Contracts negotiated in stable currency terms would require renegotiation or collapse entirely. But the domestic impact would only be part of the story. Globally, central banks holding dollar reserves would face sudden balance sheet distortions. Trade relationships anchored in dollar settlement would freeze temporarily as counterparties reassess risk. Liquidity would vanish in places least prepared for it, and in moments of liquidity shock, behavior changes fast. Businesses delay payments, banks tighten lending, consumers rush to convert cash into tangible goods. The speed of reaction becomes the multiplier. History shows that monetary crises rarely remain confined to currency markets. They spill into politics. When prices rise sharply and savings erode, public pressure intensifies. Policy responses grow reactive. Capital controls become thinkable. Emergency regulations expand. Confidence, once fractured, is difficult to restore, yet there is another pattern history repeats. After collapse comes consolidation. When a dominant currency fails, alternatives do not emerge in perfect order. They compete. Gold often resurfaces as a psychological anchor during monetary instability, not because it is convenient, but because it is perceived as neutral and finite. Strong foreign currencies temporarily absorb fleeing capital, real assets, land, energy, food production, critical infrastructure, gain renewed attention because they represent tangible utility. But transitions are not smooth. In previous monetary resets, wealth did not disappear uniformly. It redistributed. Those holding diversified or real assets often preserved value better than those concentrated in cash or fixed income instruments denominated in a failing currency. Debt burdens, paradoxically, sometimes shrink in real terms during inflationary collapse, but only if the system continues functioning long enough for repayment. The terrifying element is not simply economic hardship. It is systemic fragility. Modern economies are deeply financialized. Retirement systems, insurance models, sovereign funds, corporate financing, all are intertwined with dollar stability. A sudden collapse would test institutional resilience at every level, yet the phrase collapse tomorrow assumes immediacy. History suggests that dominant currencies rarely implode without warning signs: fiscal strain, rising debt burdens, declining confidence, external imbalances. When breakdown comes, it often accelerates existing weaknesses rather than creating new ones, and even then, replacement is rarely instant. A multipolar adjustment would likely follow, regional blocks settling. Trade in alternative currencies, gold reserves increasing in strategic importance, commodity-backed arrangements gaining visibility. The global system would not vanish, it would reconfigure. The deeper fear is not that money loses value, it is that predictability disappears. Contracts depend on stability, planning depends on price signals, societies depend on confidence that tomorrow's currency will resemble today's. When that assumption fails, behavior shifts from long-term investment to short-term preservation, growth slows, caution dominates, and once fear becomes embedded, recovery takes longer than the initial fall. So if the dollar collapsed tomorrow, the immediate reality would be inflation spikes, liquidity stress, financial market turmoil, and rapid geopolitical repositioning, but the longer-term reality would hinge on adaptation, which institutions remain credible, which assets retain utility, which nations move quickly to stabilize confidence. History repeats not because outcomes are identical, but because human reactions are: denial, panic, adjustment, reconstruction. The collapse of a dominant currency is not just a financial event, it is a test of governance, resilience, and trust, so the more unsettling question is not whether the dollar could collapse. It is whether systems built around it are prepared for volatility at scale. If stability is assumed rather than reinforced, fragility grows unnoticed, and if confidence is the true foundation of money, then its preservation, or erosion, determines everything that follows. When you imagine a currency collapse, you may picture chaos, but the more consequential shift is quieter. It is the moment people stop believing the anchor will hold, and once that belief fades, what replaces it becomes the defining force of the next era. If tomorrow challenged the foundation of global finance, would the response be panic, or preparedness? And how much of today's stability rests simply on the assumption that collapse is impossible?